Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everybody, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Reflexivity Co-founder and President Giuseppe Sette. Designed for institutional investors, Reflexivity combines trusted data with explainable AI to surface insights, not noise. On the show, we discuss the best use of AI in the investment process, whether AI will replace or enhance human portfolio managers, if there's a place for discretionary macro investing in an AI-driven world, what the next level investment research stack will look like for analysts, and more. So with no further ado, here's our show on AI tools and the future of investing with Reflexivity President Giuseppe Sette. Hey Giuseppe, thanks for coming on the show today. How's it going?
Very well. Very glad to be here. Thanks for having me.
Calling all the way from London, across the pond. Try not to keep you up too late tonight, but let's kick things off with Reflexivity. I love that name. I first heard it from George Soros and his theory of reflexivity. Can you walk us just through the name and how you came up with the concept?
Absolutely. The name is direct homage to George, and it speaks also to the core mission of the company. What we are trying to achieve is kind of higher level reasoning that you would expect from one of your own analysts or from yourself as you tackle a problem. And there is a high degree of reflection and higher thought that's required in order to deliver complex financial analysis or problem solving in general. So in a way, there is a double meaning in that name. On the one hand, it's a callback to George and the fact that we share some of his DNA, not only as global macro managers, but also because our seed investor was Nigel Miller. And second, and equally importantly, because we have a clear focus on higher level self-reflective thought processes. What comes after GPT?
Right, and with respect to George Soros and Reflexivity, prior to co-founding the company, you worked at several hedge funds focused on global macro investing, correct?
That's correct. I got my MBA from Wharton, and then I came back to London, where I studied on the risk arbitrage, equity event-driven hard event desk of Davidson Kempner. After that, I moved to Brevan Howard, where I traded the very classic version of global macro cross asset, the natural bias and propensity to fixed income. And then from there, my co-founder Jan and I were hired by Lombardo Odier, the Swiss asset manager, to manage the global macro franchise, where we once again expressed the form of traditional classic global macro, where our discretionary views were strongly informed by analytical models and the earliest use of AI. And I think that what drew me to the markets in the very first place is the fact that it's a very interesting intellectual challenge that also offers you the opportunity to deploy capital at scale. If you think about any corporate, think about any action that we do in the business at a large world, it's an investment. But sometimes the lead times, the lag times, the delivery times are very long, very typical of alternatives like real estate and private equity as well. Whereas in the hedge fund space, you have, for good or for bad, faster times that can be an exciting challenge to tackle.
And certainly global macro is perhaps the most liquid and fast-moving segment of the hedge fund industry, obviously with a massive addressable market that you can put capital to work in, currencies, rates, equities, etc. It's seemingly endless commodities, precious metals, etc. Now, what did that environment specifically teach you about how professional investors think, and did that provide the launch pad to start Reflexivity?
I think the key teaching was that theory and practice differ meaningfully. And I have two things in mind when I say that. On the one hand, as investors, we have our idea of what our process is. And in our mind, it's crystal clear. It's thorough, it's comprehensive. We check all our boxes, and we deploy rationally. In practice, we oftentimes do not do that. we do what we can with the time that we're given, and the need to respond quickly to markets that are ever evolving and are swamping us with a huge amount of information. So it's really hard to stick to your game plan, especially when things move fast. On the other hand, the other thing I mean by the fact that theory and practice are different is that everybody has biases. And I'm sure that you in your career have seen a lot of these investors that have an almost religious attachment, a form of love for some certain biases in their views of how things evolve. I'm sure you've met with perma bears, with perma bulls, and naturally you would expect that a purely rational investor will have changes in his views, will see things evolve as time evolves. So what pushed us into AI is the fact that it would be probably the best tool to solve some of these issues, insofar as we're able to bestow into the AI the way that we like to think, the way we want to invest, and let it help us stay on track.
Now let's get into the Reflexivity platform. I was wondering if you could talk to us about how it works and how it differs from a platform that many are familiar with, such as Bloomberg or something of that nature.
We're talking to very, very different products. Bloomberg solved data provision. It solved it extremely well, thanks to its omnicomprehensive nature and its speed. It's a great product, and for many of the reasons, the chat, the badge of honor that it gives you, it becomes almost a prerequisite for any manager in the last 30 years or 40 years. We at Reflexivity, we focus on a different challenge, the challenge of our times, just like data delivery was the challenge at Mike's times. And the challenge is reasoning of a higher order. What I mean by that is you can certainly use any of the vanilla models, from the GPTs to the Claudes of the world. You will find that as the complexity of your problem definition, your framework increases, they will cut corners, they will not do the job, but they will make assumptions instead of doing the analysis. And broadly speaking, these are models that are built upon language reasoning. In your career, in my career, as analysts, we've tackled a different kind of problem solving. Tackle problem solving as it applies to numerical quantitative research. And what we created is what we think comes after your LLMs, at the very least in our vertical, which is a proper problem solving AI that can think about complex problems, break them down, never take shortcuts, just formulate hypotheses, try them, fail, learn from its failure, come back and try different routes. Because the process of research is by its nature fraught with a lot of missteps and complications. You might discover that you don't have data. You might discover that the data was actually not high quality enough to do the analysis, or that your approach to the problem was faulty from a conceptual point of view. And you iterate and you try again until you find the solution, or until you accept that the problem in its current formulation can only be solved in a fuzzy way. Now imagine, to make it practical from the conceptual, imagine that you take your time and you write down, from, let's say, an equity perspective, a 10-pager where you put down your heart and your soul of how you like to dividend stock in your own sector. You hand this framework to Reflexivity and to a vanilla LLM. What you will get back is a completely different set of analytics. And a vanilla LLM will try its best to argue along the lines of the framework that you laid down. Reflexivity will take it like an analyst and will say, okay, very well, step one, I need to do this piece of work on the financials. Let me get the financials, crack my knuckles, and start to do some proper Excel modeling. And once I'm done with that, I will have the numbers to back up portions of this analysis, and I will move on to the market framework where I need to search for a lot of data. LLMs, by their nature, are lazy by construction. They will cut corners. They will try to get you something in the next, as fast as they can in a short amount of time. Reflexivity is really fast, but it solves this problem with money. We just use all the power we can to do the work as you would expect from your own analyst. And the beautiful thing is that there is a completely transparent process that you can open up to the single smallest atom of analysis to see what the platform has done.
Great. Now, to further just giving us an idea of how it works, could you walk us through, say, like a global macro trading example and how that would flow through Reflexivity in terms of assisting a portfolio manager to think about this trade?
Absolutely. I mean, many come to mind, and we're really glad that our users across all strategies have been laying down very complex frameworks and prompts and passing them over to the AI. I'll mention a couple. One was an extremely fun example that connected to when President Trump announced to Coke that they were highly, incentivized to use U.S. sugar cane rather than corn syrup from Mexico.
Right.
This was something that reminded me of my younger days in the private equity practice at Bain, where you would get this kind of question. They would tell you, okay, this is happening, you have the market impact, it's 11 at night, we want it by tomorrow morning. And you're on a caffeine haze, and you need to do this, it's going to take you 6 hours because who knows where is the data, and then you have to double check it. We passed this exact example to Reflexivity and asked it for an impact gauge on the sugar market. You can imagine how it goes. It's almost like a traditional case. How much sugar there is in a Coke can, how much sugar we can get from one single bushel of cane, and from there you build your own American case. The difference is that we got it in 7 minutes. Obviously, I didn't believe it. Like my MD wouldn't have believed me when I would have done the same work. So he told me, well, now you're going to cross-check it. We want a checklist where you show every source, you double-checked it, and every calculation, you double-checked it. After another 5 minutes, we got the response. It was absolutely magical. Beyond that, we've seen it used in a number of use cases that range from show me the impact of a change in margin requirements on futures in the next expiry of the future, to portfolio construction exercises of a complex nature that sometimes involve not just Delta One securities, but also structured products. It really runs the gamut, and it gives you a sense that you're simply talking about an extremely talented, extremely fast, good junior analyst. Do we have a senior analyst? Probably not yet, but I feel that in terms of human equivalence, we already got there. It's really impressive, and the first time we've seen the most recent version of Reflexivity truly deliver, I had the same feeling of wonder, awe, that I had the first time I spoke with GPT, in the sense, oh my God, the future is now.
Right. Now, in terms of how users are utilizing the platform, hedge fund analysts, portfolio managers, what is the most frequent use case for the platform? Would it be idea generation, risk management, position monitoring? How are your users most utilizing Reflexivity?
I'm going to say scheduled tasks at large, and I'll explain what I mean. It's almost like an overlap between maintenance and idea discovery. What I mean by this is that once you've laid down your framework for looking at the currency cross, a swap, interest rate swap, or once again a single name stock, there is a natural temptation, which is a healthy temptation naturally, which is to say, well, this is my framework, this is my watch list or my portfolio, I want you to run it every day. I'm going to give you measurements and criteria for which to bring some information back to me, because obviously you're going to do a lot of work on a continuous basis, on a daily basis, or even more frequently, depending on how volatile is the day. And I want to receive an email that tells me, hey, today you should look at cable, pound versus the dollar, or at the 2-year swap curve versus, God knows, the 5-year, or this specific stock in your due diligence. As I mentioned, this crosses the boundary between idea generation and portfolio maintenance, because you can apply exactly the same kind of firepower to both make sure that your portfolio is tracking in line with what you expect it to do, but also that your watch list is giving you the kind of opportunities that you expect it to give you. And the results are just astounding. It really lends itself to the kind of human and machine work that you would expect, where your role is to decide how to work, and the machine does the groundwork.
And speaking of man and machine, a lot of worries out in the market about AI replacing humans in various roles. Now, with respect to investment management, what's your view on that debate? Will AI replace human portfolio managers, or will AI enhance human portfolio managers?
In the short term, there is no doubt that we are getting an enhancement. It touches the core of what we do, and the fact that we became better portfolio managers when we had Excel, then we became even better portfolio managers when we had better access to data. This is just tools at our disposal. I don't think that this is going to change much in the next 5-10 years, even more, for two reasons. There's a professional generation which is tech savvy, understands technology, loves technology, and embraces it. And there is also, on the other side, a regulation framework that's going to take its time before it's actually ready to give the reins to a computer.
Right.
We obviously are ready to give the reins to a computer that is purely deterministic, statistical, hard, classical, if you want, any quant market. Who makes markets anymore by hand? Markets by how can I say, automation. But AI and its generative nature are a completely different beast. And I don't expect the regulator to come tomorrow and say, okay, here's the framework to get an AI to replace humans. So I would imagine that everybody who's on a trading desk today is safe to a degree, and it's probably going to have their best years ahead of them, because you can do wonderful things with an AI. You can be the investor you always wanted to be if you had infinite time to process information, because this is a real challenge. Like, we've always been fighting a war against the deluge of data, which increased exponentially the more time passed. And for the first time, we have a tool that can crack the problem.
And for those folks sitting in trading desks, asset managers, or even brand new to the business in investment management, I'm sure many, if not all, they're kind of overwhelmed with information and data around AI. The segment is just moving so quickly in the development and progression. It seems like there's new breakthroughs seemingly daily, and it's a lot to get through and a lot to try to adapt within the rapidly changing industry. Now, with that, and for capital markets professionals and investors, professional investors seeking to incorporate AI, where is it genuinely most useful, and where is it already better than humans in the investment process? Like, how could a human professional in the capital markets best utilize it right now?
Well, I think that there are at the very least two portions of their, if you want, research stack or whatever you want. On the one hand, there is the brute force data cleaning. I'm obviously not referring to just taking time series that are buggy and fixing data point. Hopefully that's going to be solve problems sooner rather than later, and we won't have to deal with it anymore. But rather, I mean semi-complex and tedious pieces of work. I'll give you an example that we've seen in our platform. A user asked for like-for-like performance of revenues in U.S. restaurants, and based on published reports, filings, the system came back with a number of empty cells saying, "This I couldn't find it in these restaurants." And then the user pushed back and said, "Read them better, because you're most likely going to be able to actually calculate it, because they might not have expressed it in a clear way, but you just need the two data points to give me this information." And the system came back, and from filling 40% of what it was of the table, filled 90% of it. That's powerful. Those are probably 3 hours of work saved by a junior analyst if he doesn't know what to do, and an hour by a senior analyst who's done this many times. It's a lot of money. Then, from the basis truly data grant work, there is a layer of more complex, if you want, how should I say, process refinement. We've talked a lot in the course of this conversation about you as a manager laying down your own framework and handing it over to the platform. Well, the platform doesn't have to be a very plain and silent taker of this framework. Since it's going to deal with a lot of data, analyze how the research process is evolving, the platform can speak back to you and suggest improvements in the framework. And the powerful effect of this is that it's a cycle that's self-improving and continues to finesse its own approach to markets. You might discover things that you didn't know.
And if you put on your global macro PM hat, Giuseppe, where would your favorite use case for AI be in your investment process?
Well, what I find immensely fascinating is that we are seeing how you can deal with complex quant or quantamental use cases that you would have to code for beforehand. I'll give another example. We tried to lay down a framework that brought together liquidity from several data sources, from your classic, slow-moving central bank liquidity providers to flows into different asset classes or out of different asset classes, et cetera, different frequencies, et cetera, whatever. It's something that you would have naturally solved with a piece of code in the past. And if you want, in the recent past, you would have used an app like Cursor to code it faster, but nevertheless, you needed to keep it in a format that was substantially hard-coded at the end, less flexible, and requiring you to have a modicum of understanding of how our platform works when you need to run a piece of code. We've re-implemented the same track liquidity in this market algorithm in a completely verbal way in Reflexivity. It delivered perfectly. It certainly kept a code repository behind it to give us the answers, but our way of talking about it with the platform was completely conceptual. It was enriched by the fact that the Reflexivity has a deep knowledge of financial markets and therefore was able to actually suggest amendments, new data sources, etc., etc. So the difference really comes to shine when you think about vanilla LLMs or their coding counterparts, because this is not an LLM with a coding mandate. This is a proper analyst that understands the markets and is eager to help you get to where you want to get and to maintain your models. And the results are extremely, extremely encouraging. And we ride the tech wave, and it gets better by the day.
And taken to its sort of logical conclusion, say one day everyone has, the top LLM incorporated into their process. Now, paradoxically, what happens then? Where does the edge come from? And can alpha still be generated in that type of market?
I would say definitely, because I have a almost trivial counterpoint. It's not that we stopped delivering alpha when we got Excel or when we got Bloomberg. These are tools.
Right.
Like every tool, it's what you do with it that makes the difference. Markets are complex and they adapt to the market participants' behavior. So naturally, you can expect that we will be better able to go into the corners. I think that this is going to have a massive impact, for example, into the small cap space, very small cap space, where you will all of a sudden start to demand more data from the companies because you have the power to process this data and to search for new opportunities. But once again, it will be a matter of what in different environments would call research taste, which is where are you going to push the AI? In which directions are you going to point the spotlight to find your opportunity? It's obvious that if you're thinking about trading a massive stock that's heavily market on which market makers are extremely active, large hedge funds are extremely active, well, you're probably going to fight a battle that's uphill. But generally speaking, I think an investor doesn't take a Tesla stock trying to beat a manager. You take a Tesla stock on the basis of growth, and therefore that's a different kind of allocation you do. You as a manager will be able to explore the small cap space, dive so deep into private markets because you will be able to hand over so much documentation to the AI and get back proper analysis. So imagine an opening up of all those very, dark and illiquid pools of credit that currently are traded by a few hedge funds. So I'll conclude by saying alpha is always going to be there because it's a relative value game, and we will have a chance to make all markets more liquid because we will understand them better.
Right. And you mentioned, as an ode to the great global macro investor George Soros, naming the company after one of his theories. Now, with that, Soros was really the archetype for that old school shoot from the gut global macro trader. And he did it very well. And I remember reading he had some unique signals. For example, if he had a position going against him and he wanted to sell, his signal was lower back pain. So somewhat unique one that not all of us have. But with that, the incorporation of AI moving forward and the implications for global macro investors, is there still room for those old school sort of shoot from the hip type, cowboy style global macro investors?
I think there's more than ever a great opportunity for global macro of a discretionary nature, although the nature of global macro will change. And it's going to be starting from a recognition that horizons matter. The shorter-term horizons where considerable amount of alpha was captured back in the Gunslinger days, if you want, are probably gone. There's a tragedy of the commons because you cannot simply defeat market makers and quant hedge funds that are traveling at the speed of light and deploying millions of research budgets. However, in the longer term horizon, where understanding matters, this is the opportunity of a lifetime because we will have better tools to analyze, gauge, and make hypotheses about what's going to happen in the economy around the next quarter or year or multi-years. Think about what happened just now. We've had Kevin Walsh, who was actually working at Druckenmiller's investment firm before accepting the nomination. We had Kevin Walsh announcement, and the market had a reaction that was in part due by positioning and in part due by fundamentals.
Yep.
Now that the market has cleared up its head, we can look back at the fundamentals. Kevin has very clear views about what's going to impact the economy in the future, and if you dig deeper into those, that will help you understand what the Fed is going to do in the future. These are true market drivers that are not of interest to the ultra short-term market makers, but that can be basis of a very powerful global market strategy.
And with that, prior to letting you go, Giuseppe, just one last question. I'd be remiss if I didn't ask you, as a global macro guy, what's your favorite macro trade for 2026?
Oh, that's a good one. What's my favorite global macro trade? I think that there are at the very least two very classical things that I'd like to look at. On the one hand, I think that it's very hard to buy into equities at this level, and that makes them all the more compelling. Obviously, valuations are very high, but we need to acknowledge that productivity might be at a turning point where AI is going to take both the role of China in depressing inflation, China of the last 20 years naturally, and also the engine of growth that led the market higher in the 60s, for example. On the flip side, so I think that even though valuations might look high, we have not seen the impact of AI and productivity in the earnings of second order and third order companies. Therefore, I don't want to belabor the point because that global macro managers can talk a lot. I think that earnings are going to do well, and this is going to be enough for the market to continue going higher. Besides and beyond that, I wonder what's going to happen to the US curve. A new manager with a new chairman of the Fed with very clear views, a change in the structure of the Fed's mandate, a desire to shrink the balance sheet, the curve is going to start to do things. And things is a broadly defined concept that's going to be impacted first and foremost by whether we start again in earnest to do aggressively quantitative tightening, as well as the role of expectations if we start to cut rates and people disbelieve that AI is going to give us these inflationary pressures. All of this put together makes me think that there's going to be an opportunity for the curve to find some extremes that you might be able to fade one way or another.
Interesting. So interest rate volatility and perhaps some steepening there. That said, Giuseppe, thanks so much for coming on the show, explaining reflexivity and a lot of the developments in artificial intelligence as it applies to investment management. Personally, I'm very excited. I'm incorporating new AI tools seemingly on a daily basis, and it's extremely powerful. And I'm super excited to see what is in store for the future. So thank you very much for coming on the show.
It's a pleasure.
All right. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.